Credit rating agencies in India. We all know that credit rating is used extensively for evaluating debt instruments. In this lesson, we will explain the meaning and determinants of credit rating, describe the advances and limitations of credit rating, identify the credit rating symbols, and discuss credit rating agencies in India. After going through this presentation, you should be able to explain credit rating, describe RBI guidelines for credit rating, discuss credit rating and information services of India Limited, explain investment information and credit rating agency of India Limited, understand credit analysis and research limited, define advantages and limitation of credit rating. A credit rating assesses the credit worthiness of an individual, corporation, or even a country. Credit rating are calculated from financial history and current assets and liabilities. A credit rating tells a lender or investor the probability of the subject being able to pay back a loan. A poor credit rating indicates a high risk of defaulting on a loan and thus leads to high interest rates. It is based upon the history of borrowing and repayment, as well as the availability of assets and extent of liabilities. Credit is important since individuals and corporations with poor credit will have difficulty finding financing and will most likely have to pay more due to the risk of default. Credit ratings are rating agencies' opinion on relative degree of safety regarding debt obligations being met on time for a structured instrument and standalone. Moody's ratings are designed exclusively for the purpose of grading bonds according to their investment qualities. Australian ratings. A corporate credit rating provides lenders with a simple system of gradation by which the relative capacities of companies to make timely repayment of interest and principal on a particular type of debt can be noted. RBI has accepted and introduced the Basel II guidelines and announced timelines for their introduction and compliance. While adopting the Basel II framework, RBI has opted for the standardized approach towards credit risk, which called for third-party credit rating, and the basic indicator approach towards operational risk, in which case too external rating may be applied to determine capital charge for market and operation risk. RBI has prescribed credit rating of all loan assets. RBI has adopted the global practice of having acceptable third-party evaluation of assets on banks' books. RBI has also prescribed 150% risk weight on borrower accounts that have not been obtained such credit ratings upon expiry of this deadline. The underlying implication is that the limits below the threshold limit also need to get the credit rating done. The RBI had also spelled out reduced risk weights as under for accounts rated by the accredited agencies are 20% risk weight, AAA rated 30% risk weight, AA rated 50% risk weight, A rated 100% risk weight for lower ratings and 150% for unrated. Under the above RBI prescriptions, differential risk weights have a positive impact on banks' lendable surplus. A credit rating agency means a body corporate engaged in then business of rating of securities. In India, presently, there are following three credit agencies: Credit Rating and Information Services of India Limited, CRISIL; Investment Information and Credit Rating Agency of India Limited, ICRA; Credit Analysis and Research, CARE, etc. Registration with SEBI is mandatory and an application in writing on Form A along with a non-refundable fee is required to be submitted by the agency. This includes code of conduct, agreement with the client, monitoring of ratings, periodic review of all published ratings during their lifetime, framing of suitable internal structure in respect of various systems and procedures prescribed under SEBI Insider Trading Regulations 1992, SEBI Prohibition of Fraudulent and Unfair Practices Relating to the Securities Market Regulations 1995, and other laws relating to trading of securities, submission of information to SEBI, compliance with the circulars issued by SEBI, appointment of compliance officer, maintenance of books of accounts and returns, compliance of auditor's report within 2 months, maintenance of confidentiality, etc. Credit Rating Information Services Limited is the first credit agency floated on January 1, 1988. It was jointly started by ICICI and UTI with an equity capital of 4 crores. CRISIL is India's leading rating agency and is the fourth largest in the world. With over a 60% share of the Indian ratings market, CRISIL Ratings is the agency of choice for issuers and investors. CRISIL Ratings is a full-service rating agency that offers a comprehensive range of rating services. CRISIL Ratings provides the most reliable opinions on risk by combining its understanding of risk and the science of building risk frameworks with a contextual understanding of business. The principal objective of CRISIL is to rate the debt obligations of Indian companies. Its rating guides the investors about the risk of timely payment of interest and principal on a particular debt instrument. CRISIL's rating process and rating committee are designed to ensure that all assigned ratings are based on the highest standards of independence and analytical rigor. The rating committee comprises members who have the professional competence to meaningfully assess the credit analysis that underlies the rating and have no interest in the entity being rated. A team of analysts carried out the credit analysis. Investment Information and Credit Rating Agency of India (ICRA) Limited, an associate of Moody's Investor Service, was incorporated in 1991 as an independent and professional company. ICRA is a leading provider of investment information and credit rating services in India. ICRA's major shareholders include Moody's Investor Service and leading Indian financial institutions and banks. With the growth and globalization of the Indian capital markets leading to an exponential surge in demand for professional credit risk analysis, ICRA has been proactive in widening its service offerings, executing assignments including credit ratings, equity gradings, specialized performance gradings, and mandated studies spanning diverse industrial sectors. In addition to being a leading credit rating agency with the expertise in virtually every sector of the Indian economy, ICRA has broad-based its services for the corporate and financial sectors, both in India and overseas, and currently offers its services under the following banners: Rating Services Information, Grading and Research Services, Advisory Services, Economic Research Outsourcing. ICRA was set up by Industrial Finance Corporation of India on 16th January 1991. It is a public limited company with an authorized share capital of 10 crores. The initial paid-up capital of Rs 3.50 crores was subscribed by IFC, UTI, LIC, GIC, SBI, and others. Long-term debenture bonds and preference shares rating symbols: LAAA highest safety, LAA high safety, LA adequate safety, LBBB moderate safety, LBB inadequate safety, LB risk prone, LC substantial risk, LD default extremely speculative. Credit Analysis and Research Limited (CARE) was promoted in 1993 jointly with investment companies, banks and finance companies. Services offered by CARE are credit rating information service, equity research, etc. Long-term debt instruments rating symbols CARE AAA highest safety, CARE AA high safety, CARE A adequate safety, CARE BB inadequate safety, CARE B high risk for medium-term debt instruments, CARE C high risk. DCR is a joint venture between Duff and Phelps USA and Alliance Capital Limited, Calcutta. This is the youngest of all credit rating agencies in India. Its expertise is in the rating of structured obligations with international standards. It offers rating of all other short-term, medium-term and long-term debt instruments. In the US, Standard & Poor's, S&P, Moody's Investor Services, and Fitch are some of the important firms engaged in credit rating functions. Advantages of credit rating are: rating safeguards against bankruptcy through recognition of risk. It gives an idea of the risk involved in the investment. It gives a clue to the credibility of the issuer company. Rating symbols give information on the quality of instrument in a simpler way that can be understood by lay investor and help him in taking decisions on investment without the help from broker. A company whose instruments are highly rated has the opportunity to have a wider access to capital at lower cost of borrowing. Rating also facilitates the best pricing and timing of issues and provides financing flexibility. Financial intermediaries like banks, merchant bankers, and investment advisors find rating as a very useful input in the decisions relating to lending and investments. Regulators can, with the help of credit ratings, determine eligibility criteria and entry barriers for new securities, monitor financial soundness of organizations, and promote efficiency in debt securities market. The credit rating helps business counterparties in establishing business relationships, particularly for opening letters of credit, awarding contracts, entering into collaboration agreements, etc. Limitation of credit rating. Credit ratings are changed when the agencies feel that sufficient changes have occurred. The opinions of rating agencies may turn wrong in the context of subsequent events that may have an adverse impact on asset quality of the issuer. The use of credit ratings imposes discrete categories on default risk, while and in reality default risk is a continuous phenomena. A borrowing company can reduce the cost of borrowing if it obtains a higher rating for its contemplated issue. Rating agencies became overcautious and resorted to drastic downgrades of ratings in respect of specific companies. Most investors prefer to use credit ratings to assess default risk. The bond issuers pay the rating agency to evaluate the quality of the bond issue in order to increase the information flow to investors and hopefully increase the demand for their bonds. The rating agency determines the appropriate bond rating by assessing various factors. The highest grade bonds whose risk of default is felt to be negligible are rated AAA. The rating agencies assign plus or minus, for example AA plus or A plus, when appropriate to show the relative standing within the major rating categories. Credit rating does help in assessing the financial risk that can lead to default. The ratings assigned to a bond issue directly affect its yield. Investors often use the highest rating category as a benchmark yield and compute yield spreads for lower rated bonds. AAA rated bonds always sell at lower yields than AA bond, which in turn sell at lower yields than A minus rated bonds, and so forth. Now let's see how much you have learned till now. State whether the following statements are true or false. AAA rating indicates highest safety. True. All types of bonds, including small issues, are rated by a credit rating agency. False. The rating agency is obliged to assess the debt issue till its maturity and publish the rating as a part of its surveillance system. True. Before we end, let us briefly revise what we have studied so far. The term credit rating refers to evaluation of debt instruments. Debt instruments include both long-term instruments like bonds and debentures and short-term obligations like commercial paper. Convertible debentures are the debentures which are convertible into equity shares of a company, either wholly or partially, at the option of the debenture holders are called convertible debentures. Rating serves as a useful tool for different constituents of the capital market, namely investors, issuers of debt instruments, financial intermediaries, business enterprises, regulators, etc. Financial risk is risk which is associated with the pattern of financing a business, X for example, greater proportion of debt. When two rating agencies give the same security different ratings, it is called split rating. Issuers of high-risk securities have to pay higher rates of return than issuers of low-risk securities. A number of difficulties arise in the quality rating assigned to an issue.